Picture yourself at 47 years old on an ordinary Thursday evening. You are sitting at your dining room table, laptop open, checking account displayed on screen. You've just transferred $38,000 to your mortgage lender. It represents the final chunk of your emergency savings, the remains of a bonus you received last year, and some inheritance money from a relative. But it feels incredible. You close the laptop, lean back in your chair, and exhale deeply. You've accomplished it. Your mortgage is completely paid off. The property is yours outright. The title belongs to you entirely. A profound sense of relief washes over you. You drift off to sleep that evening convinced you, executed, the most prudent, safest, most financially responsible move of your entire existence. Fast forward 9 months. Your employer announces restructuring, your entire department gets eliminated. You are unemployed, the economy has shifted, and your industry is contracting rapidly. You have zero income flowing in. You examine your checking account and discover it is practically empty because you liquidated everything to eliminate that mortgage debt. You need purchasing groceries. You need covering the utility bills. You need replacing the water heater that just failed. You glance around at your walls. You are acutely aware there is $600,000 of equity locked inside the structure. But you cannot purchase food with drywall. You cannot pay the plumber with your foundation. You approach your bank requesting a home equity line of credit, and they decline immediately. We cannot extend credit to you. They explain you lack employment. You are literally sitting inside a mountain of wealth, and you are financially drowning. This represents the liquidity trap. By fixating on becoming debt-free, you've mathematically engineered your own vulnerability. You exchanged your liquid flexibility for an achievement badge on your credit profile, and through this decision, you incinerated hundreds of thousands of dollars in potential future wealth. I am Leo, and I dedicate unreasonable amounts of time analyzing the emotional narratives that prevent people from optimizing their financial situations. If you are currently someone who is sending an additional $600 monthly toward your mortgage principal because you crave that sensation of freedom, or if you are carrying a low interest rate but still experiencing guilt about maintaining debt, make sure to hit that subscribe button and give this video a thumbs up if this provides value, because today we redismantling one of personal finance's most sacred beliefs. We re-examining why aggressively paying off your mortgage early frequently represents a mathematical catastrophe. We re-exploring the concept of trapped equity, the mechanics of inflation arbitrage, and why maintaining your mortgage indefinitely might actually constitute the safest financial strategy available. Here is the fundamental issue with the payoff the mortgage philosophy. It is propelled by emotion, not mathematics. It is driven by an instinctive fear of debt, inherited from our grandparents' era. During the 1930s or the 1980s, when interest rates hit double digits, eliminating debt was literal survival. If your mortgage carries 14% interest, paying it off delivers a guaranteed 14% return. That is obvious. But we exist in a completely different mathematical environment today. Even with current rate fluctuations, if you are holding a mortgage with an interest rate of 3, 4, or even 5%, and you are aggressively reducing the principal, you are effectively investing your capital into a savings vehicle that yields 3 to 5%. That represents the return on investment of debt elimination, the interest you are saving. Now pose this question to yourself. Would you voluntarily lock your money inside a savings account paying 3% that imposes massive penalties for early withdrawal? Absolutely not. You recognize that as a terrible investment. You acknowledge you can secure 5% in a money market fund. Immediately, you allocate that capital to the S&P 500, which historically delivers 8 to 10% returns. By paying off your mortgage, you are selecting a 3% return over a 10% return. You are voluntarily accepting inferior yields on your capital because the word debt triggers psychological discomfort. You are paying what I call a fear tax. Let's examine the concept of arbitrage. This is precisely how banking institutions accumulate wealth, and it is exactly how you should conceptualize wealth. Building a bank borrows your money through your savings account at 0.5% interest, then lends it back to you via a mortgage at 6% interest. They capture the spread. That spread represents their profit. You can execute the identical strategy in reverse. If you're holding a mortgage at 4% and you can invest in markets returning 8%, that 4% spread becomes your profit. It is essentially free money generated through leverage. Let's use specific numbers. Suppose you possess $100,000 in extra cash. You face two options: pay down $100,000 of your 4% mortgage or invest it earning 8%. If you eliminate the mortgage debt, you save $4,000 annually in interest. If you invest, you earn $8,000 annually. The difference equals $4,000 yearly compounding indefinitely. Across 30 years, That single decision to invest rather than eliminate debt creates hundreds of thousands of dollars in additional wealth. By paying off the house, you're destroying the arbitrage opportunity. You're terminating your most productive wealth, building tool, leverage, and choosing to do everything manually yourself. Now you might be thinking, Leo, debt represents risk. What happens if markets crash? And this is precisely where we need redefining what risk actually means. Most people define risk as owing money. I define risk as lacking access to money. This is the liquidity risk argument. When you direct extra principal toward your mortgage, that money vanishes. It transforms into home equity. Equity is dormant capital. It generates zero cash flow. It cannot be spent. It sits idle, accomplishing nothing until you sell the property or borrow against it. But borrowing against it becomes extremely difficult when you're experiencing financial distress. Banks extend credit to people who don't need it. If you lose employment, your credit score collapses, or housing markets crash, that equity becomes trapped. Your property, rich but cash poor. Compare that to someone who maintained the mortgage and directed extra money into a brokerage account. They can cover mortgage payments for 5 years using their liquid holdings. Who possesses greater safety? The person with the paid-off house and zero cash, or the person with the mortgage and $500,000 in the bank? The person with cash is dramatically safer. They possess options. They have runway. The person with the paid-off house has shelter, but they have no engine. If they cannot cover property taxes, which you still owe even with no mortgage, the county will seize the house regardless. So the notion that a paid-off house guarantees security is fundamentally a myth. Cash guarantees security. Liquidity guarantees security. Paying off the mortgage destroys liquidity. This becomes genuinely fascinating when we examine inflation's role. Inflation is the saver's enemy but the debtor's best friend. When you obtain a 30-year fixed-rate mortgage, you're locking your housing cost for 3 decades. The principal and interest payment never changes, but the dollar's value erodes annually. In 2025, you might be paying $2,000 monthly. That feels substantial. It might represent 25% of your income. But in 2055, due to 3% annual inflation, $2,000 will possess the purchasing power of roughly $700 today. Your income will likely have doubled or tripled. You'll be repaying the loan with depreciated currency. The bank is losing on this arrangement. They lent you valuable 2020 $5, and you're repaying them with devalued 2050 $5. By paying off the mortgage early, you are destroying this advantage. You are repaying the bank with today's valuable dollars instead of tomorrow's cheaper dollars. You are essentially gifting the bank. You should extend that loan as long as humanly possible to allow inflation to erode the debt's real value. The mortgage effectively becomes cheaper every single year without you taking any action. Let's discuss the opportunity cost of extra payments. This represents the invisible wealth you never witness because you destroyed it. Suppose you have a $2,000 mortgage payment and you decide aggressively paying an extra $1,000 monthly to eliminate it in 15 years, instead of 30. You feel virtuous. You feel like financial gurus would approve. But let's simulate the alternative. If you directed that $1,000 monthly into a low-cost S&P 500 index fund for those same 15 years, assuming historical 10% returns, you deaccumulate roughly $400,000. But wait, you continue because you didn't eliminate the house debt. You maintain the mortgage for the complete 30 years. You continue investing that $1,000 monthly for another 15 years. At 30 years conclusion, your investment account is worth approximately $2 million. Meanwhile, the responsible person who paid off the house early possesses a paid-off house worth maybe $800,000. Appreciation occurs regardless of the mortgage, and zero investment account. The net worth difference exceeds $1 million. The decision to rush the mortgage payment cost you $1 million. That is the price of your peace of mind. It is an extraordinarily expensive luxury. And here's what most people don't realize about paid-off house psychology. We think it unlocks freedom. We think once the house is paid off, I can invest. But life intervenes. Parkinson's law activates. When you no longer have that mortgage payment, you don't typically sweep that money into investments. You upgrade your lifestyle. You purchase recreational vehicles. You take more expensive vacations. You absorb the surplus by maintaining the mortgage. You enforce savings discipline, not in house equity, but in the fact that you must budget for the payment, which restrains your lifestyle consumption, allowing you to invest surplus elsewhere deliberately. Furthermore, having a paid-off house places a massive target on you for litigation. If you get sued and you possess 100% equity in your home, That is an attractive asset for creditors to pursue. If you have a mortgage for 80% of the value, there is minimal equity for anyone to claim. The bank technically owns the house, which functions as a form of asset protection. You appear poor on paper with high debt, which makes you unattractive for litigation while you maintain your real wealth liquid and protected in brokerage accounts. We also need addressing tax implications, although these have evolved. It used to be that mortgage interest deduction was a huge reason maintaining debt. With the higher standard deduction in 2025, fewer people itemize. So I am not even basing this argument on tax savings. Even without the tax deduction, the mathematics of arbitrage and liquidity still prevails. However, if you do itemize, the government is essentially subsidizing your rate. If your rate is 4% and you're in a 25% tax bracket, your effective interest rate is 3%. That makes the hurdle rate for investing even lower. It makes maintaining the debt even more profitable. Now I know the counterargument. I can anticipate the comments already. Leo, you are not factoring in risk. What if markets are flat for 10 years? What if I retire and cannot make the payment? These are valid emotional concerns, but they resolved by the liquidity buffer. Remember, in the investing scenario, you possess a massive pile of liquid cash growing continuously. That pile is your risk mitigation. If markets are flat, you still possess the principal. If you retire, you can utilize the investment income to pay the mortgage. You can create your own synthetic payoff. If you possess $500,000 in investments earning 4% dividends, that $20,000 annually pays the mortgage for you. You are mathematically debt-free because your assets cover the liability, but you maintain control of the principal. That is true financial independence. Handing the principal to the bank means you lose control. It means you are requesting permission to live in your own house. The only time it makes sense paying off a mortgage early is if the interest rate significantly exceeds what you can earn in markets. If you have a mortgage at 8 or 9% in a high-rate environment, then yes, pay it down. That is a guaranteed 9% return that beats the market. Or if you are incapable of saving money, if you know factually that if you don't pay the mortgage, you'll spend that money on frivolous purchases, then pay the mortgage. It functions as a forced savings account for the undisciplined. But if you are watching this channel, I assume you are disciplined. I assume you are attempting to optimize. For the disciplined investor, low-interest mortgage debt is an asset. It is a relic of a low-interest era we may never witness again. To pay it off early is to destroy a valuable financial instrument. You are discarding a below-market loan that allows leveraging your wealth. This requires an identity shift. You must stop viewing debt as sin. Debt is a tool corporations use debt, governments use debt, the wealthy use debt. They use it amplifying returns, they use it maintaining liquidity. Only the middle class is taught that debt is evil. We retaught to rush to zero, but zero is a dangerous place to be. Zero leverage means zero amplification, zero liquidity means zero options. So here is the actionable step. Stop paying extra. Take that extra $200 or $500 or $1,000 you are sending to the mortgage company every month. Open a separate brokerage account. Label it your Freedom Fund. Set up an automatic draft for that same amount into an S&P 500 index fund. Watch that account grow. In 10 years, compare the balance of that account to the interest you would have saved on the mortgage. You'll see the mathematics with your own eyes. You'll see that you are tens of thousands of dollars wealthier. And more importantly, if you have an emergency tomorrow, you can access that money. You cannot access the extra payment you sent to the bank last month. That money is gone. We need to stop optimizing for sleeping well at night based on outdated generational logic and start optimizing for sleeping well at night because we have a fortress of liquid cash that can handle any crisis. A paid-off house is a trophy. A massive investment portfolio is an army. I'd rather have the army. If this video made you pause that extra principal payment, share it with a friend who is obsessed with being debt-free and help them see the mathematics. Thanks for watching, and I'll catch you in the next one. I am not a financial advisor, mortgage expert, or licensed financial professional. The content on this channel represents personal opinions only and is intended for educational and entertainment purposes. Please conduct your own research and seek professional guidance before making any major financial decisions. See you next time.